My Uber friends, my Lyft friends, my YouTube subscribers, Rideshare Professor here. I have a very special guest with me today, Alex from BusinessRocket.com. I'll put the link under the video for you guys afterwards. And this is an interesting one, right? When it comes to taxes, this is a huge one. And the way you set yourself up can lead to a lot of savings. And I'm going to hand the ball right straight over to Alex, who's going to explain the difference between these two, the LLC and the SCorp, and what advantages you have going the SCorp route. Alex, go ahead.
Right, so here at BusinessRocket, we've been in business for about 10 years. We've been opening companies for all different industries. And in the last 2-3 years, we've been really specializing in the rideshare, self-entrepreneur type of business. And as you know, this is the question you get all the time. Torsten calls me about it, I don't know, a couple times a week about it.
At least.
Let's kind of go over the difference between taxes as a Schedule C taxes, which is a sole proprietor, or a single member LLC, versus an S corporation. For our example today, let's just use 80,000.
I think 80,000 is fair. If you're making 80,000 in X or XL as a gross, or SUV Lux, we'll use that figure.
So this is the gross figure. That's basically what you made before any expenses, you know. So being an Uber driver, you generally make, what, $1,500 a week.
Right.
You have your expenses and so on. So this is the gross figure before any expenses. Then we have our general expenses.
I'd say about, let's use $30,000 as an example.
So this would basically be your gas, your car payments, your waters, your car washes, anything that you have to spend money on to actually make that $80,000. Now this does not include money that you've paid yourself, so let's keep that separate. So what happens? In a sole proper LLC Schedule C, at the end of the year, for our example, we're going to focus on December 31st, 2019. And on that date, you have $50,000 laying in your account. Let's assume Torsten hasn't spent a penny.
Right,
He's been saving every single penny. It's all just laying there, and he's got one day to figure out what to do with it. What do? So if you're in a sole prop or an LLC, which generally means you're doing Schedule C taxes, you're going to have to pay self-employment on this whole amount. And it obviously depends on your personal tax bracket. You include all your other income, and it kind of establishes where you're going to be. But for our example, let's just kind of go from anywhere from 22 to 35% total tax.
Okay.
And let's just pick the number 30, just
for
simple numbers. So let's say 30%. 30% is basically what we're assuming is going to be a tax rate that Torsten is going to fall into. So in this situation, Torsten is going to have to pay
let's say
$15,000 in taxes. You know what I say to that? I say a big fat boo. That's what I say. Wrong. So in our S-Corp situation, there's kind of a little bit of a difference. So up until this point, it's exactly the same.
Okay.
You have the same expenses, the same income, but the bottom line now becomes a little bit different. In an S corporation, you get to control, Torsten, how much money you made as an employee, and how much money you made as an investor of your own company.
So dividends that I'm paying myself out.
Exactly. Okay. So imagine one, you getting a paycheck, and one, you just take money out of your company quarterly or once a year, however you decide.
Okay.
So for our today example, we're going to use employee money and investor money. My accounting friends are going to kill me for using that word, but for our simplicity's sake, that's what we're going to use here.
Okay.
So let's just assume you paid yourself $25,000 as an employee of your own company.
Okay.
Which means that you have $25,000 left to make as an investor of your own company.
And is that a typical ratio, 50-50, or how should you structure that?
You know, obviously if you have a CPA, ask your CPA what's the best ratio for you. We generally like to stay somewhere in the middle. It obviously depends on the job and how much money you make. If you guys call me, I can explain all that to you. But generally 50-50 is a very safe number to go.
Okay.
So in this situation, we're going to assume that $25,000 is going to be treated exactly like a Schedule C LLC, where you're taxed about 30%.
Right.
So on this money, you're going to pay about
$7,500, let's
say. $7,500. However, the second $25,000, you're treated as a passive investor of your own company, meaning you weren't the one doing the work, even though you were. That's kind of the benefit of an S corporation. This one's taxed at 15%. So what is that? That's
$3,750.
Yeah, approximately. So
call it $11,250.
You just saved Torsten $3,750 by going down the tax SCorp route. Now, when you're going to go to your accountant's going to right away say, but Torsten, the S corporation is more expensive. You have more liabilities. You have to do more things. It's true.
Definitely can't be.
Yeah, but it's not $3,750. You know, you might spend an extra couple $100 throughout the year. You may have to spend a little bit more on your accountant to do the taxes this way. But bottom line is, if you're making good money in this industry, it's foolish not to be an S corporation. Now, I know, disclaimer here, every state has its own regulations, and there's differences that kind of happen there. We are in California.
Okay.
If you guys call me, I can explain that in whatever state you're in. We can always kind of do an analysis on it. So, disclaimer, this is kind of a primarily California example, but it does apply against most blue states where taxes are a little bit higher.
Okay, great. So just, looking at that very basic model, starting out with a gross of about 80,000, we just use expenses as an example, 30,000. We actually made about $3,750 more following that route. If you have any questions, reach out to the gentleman, and I truly appreciate your time.
No problem.
Thank you.